I want to cover how to illustrate loans on your pending illustration or your in-force illustration. So in the debt consolidation program, I'm sure there's going to be a time where your client will want to take loans from the policy in order to pay off debt. So you want to be able to show your client what that will do to their policy value. As a reminder, a loan taken on a policy can be paid back into the policy and will replenish the policy cash value. Our loan rate is 5%. If a client takes a withdrawal, that's considered a partial surrender of the policy and cannot be paid back into the policy. So something that can't be paid back into the policy will not replenish the policy cash value. So I want to show you how this works. So here's an illustration that we have that just has been illustrated with a monthly premium of $533 and on a monthly basis, $6,400 annually. The premiums go to age 75, and then contractually the policy is paid up. So you can monitor your client's cash value by just following the net cash value column on the non-guaranteed side. Or you can always go to your client's book of business and access their policy information report to see their current cash value and loan availability. So for now, I'm going to just minimize that particular illustration. So there are two ways to illustrate a loan. You can opt for the solve option, which will take you to the income stream solve and let you solve for the max amount of loan that would be available to the client. Alternatively, you can just skip right to the loans and withdrawals tab and manually enter an amount that you know the client wants to take. So for instance, if you know in 3 years the client's going to be ready to pay off debt, and in that particular year they want to take one loan for, let's say, $5,000. You can just enter that amount in the column and the loan will show up on your illustration. So let's go back to the first method of doing the income stream solve. So of course you're going to go to the solve option. You're going to select income stream, and generally these boxes are blank or pre-filled with a random number. So just to show you what each box is asking for, I'm going to go through the prompts here. So the first box is asking how much cash value you want to be left at a certain age. So the rule of thumb is if you have a lower cash value left at a shorter age, the client's going to get more living income. If you have a higher cash value that you want to be left at a later age, say maturity, 121 for all of our policies, then the client is going to have a lower income while living, because the policy will try to preserve itself to that age of maturity or try to keep a larger amount of cash value in the policy at a later age. So for demo purposes, I'm going to use $100 in cash value left at age 100. The next item will ask what income type you would like. So here is where you would select from your loan or withdrawal. I'm going to select a loan, and the next box is asking what age you want that loan to start. So if I want my client to see their first payment on the illustration at age 50, I'm going to go back in age and start this at age 49 so that their payout will show up at age 50 on the illustration. And then you're going to tell the system how many years you want that payment to go. And for this example, I'm just going to ask for one particular year. You can make this any amount of years that you want, 5 years, 10 years, however you want. We're going to demonstrate 1 year. So once you have those parameters filled in, you can select the view illustration either from the top or the bottom of the page, and your illustration is going to generate. When you request a loan, you'll get this extra page labeled Supplemental Illustration Loan. If this item or page doesn't show up, that means that something wrong was done in your request, or it just can't happen. Maybe there's not enough cash value, or the parameters you entered are incorrect. So I'm just going to go straight to the Supplemental Illustration Loan page and increase this up a little bit. So this tells us that at age 50, the client can receive a max payout of $19,581. And we see that our loan interest, 5%, is $979, making our loan balance right away $20,560. Sorry, I'm kind of highlighting too much there. So this is the client's loan balance as it stands until they start making payments back to the loan. So please keep in mind that our loan rate is 5% and it is compounding. So what you're going to see is the first year of $979 as the interest amount. The next year's interest is going to be based on the balance. So 5% of $20,560 is our $1,028, and so on and so on. So just keep in mind that as long as the client is not making payments back into their loan, then that's going to increase their balance and, of course, their amount of loan interest. Next, you'll see in the net premium outlay column a negative amount. This can be a little confusing to you or your client. What this generally means is that you're paying in $6,400 annually, or your $533 per month, and you're taking a loan of $19,581. So the difference is going to be $13,181. So your client will actually still receive $19,581 as their payment. So hopefully they don't get confused and think they're only going to receive a check for $13,181. This just tells you that because premium payments are coming into the policy, that's just the net premium outlay. Now, when you are requesting a loan amount, we get a lot of inquiries about the amount that's available. Typically, 80 to 85% of your net cash value is available for loan. Keep in mind, though, that if you're requesting different parameters, your loan amounts could be different throughout the years. Also, something that could change the loan amount available is if your client kind of goes off of the schedule premium paying period. So if they're not paying the same amount into their LPUA rider, that could change their loan amount available. Or if they go on a premium offset or have the premiums taken out of the policy cash value, that could also change their loan amount. So just keep those general things in mind. The last thing that I would want to show you on this particular illustration is the fact that we're a non-direct recognition company. And that means that if your client takes a loan on their policy, the cash value will change because, of course, that's typically a loan from their cash value, but their dividend amount will not change. The dividend amount will still be awarded as if the loan were not taken. So for this particular year, the dividend was $1,031, which would be the same as if the loan were not taken. So that's going to make your client very comfortable in knowing that when they make their premium payment, their return of premium or dividend is still going to be the same. So that's going to continue to grow the policy moving forward. So let's go to a manual loan or withdrawal solve. So by going to the loans and withdrawals tab, like I said earlier, you can manually enter an amount that the client may want to take. So for instance, if you solved for the maximum amount that the client can take, and we got an amount of $19,581, what if hypothetically the client might want to take a little less or maybe a little more? So I'm going to delete what's here just so that it doesn't kind of muddy up the waters. And I'm going to go to the following year. And for 1 year, or I can duplicate this for 5 years or 10 years. To make it easy, I'm going to duplicate for 1 year. I'm going to go to the following year. And I'm going to request $20,000 just to see what we come up with. So it's a good sign. I have my supplemental loan page. And we see that a $20,000 loan is available that particular year. And we have a $1,000 loan interest, making our balance $21,000. And the balance moves forward until the client pays off the loan. So let's take a look at what it would look like if your client repays the loan. So we have our $20,000 here, and we saw that right off the bat we have a $21,000 balance. So let's say the client wants to pay back this loan over 5 years. So I'm going to add $5,000 annually for 5 years. That's what they can commit to pay on top of their premium amount. So I see that my $5,000 is there for 5 years, and let's see what that produces. So here we have our $5,000 being paid back onto the loan annually. And in the last year, we didn't quite owe the full $5,000, so the software is not taking any more than what is owed. Now, technically, the client could pay more than what's owed, and if there's room in the level paid up additions rider for that additional money to go to, that's where it would go. So we can see that there are no other loan balance here and no other payments due, and of course the cash value is restored. Okay, I'm going to get rid of that one. And for this particular demo, I'm going to do maybe a loan amount that would go on for several years. So as you can see, I'm getting rid of the other amounts that are in the illustration each time so that the amounts don't overlap. So let's go back to the Solve tab. let's solve for income stream, and let's make this $100 left at age 90. We want a loan starting at, we want to see our first payout at age 50, so I'm going to leave this at age 49, and then I want to see what a 5-year loan would look like. Okay, so for a 5-year loan, we have $7,762 annually. We have our loan interest and our loan balance. And just to check my figures, it looks like we still have the policy going to age 105, so that's good. We can probably shorten that, work to kind of go back and forth to maybe shorten that if your client doesn't want it to go for that length of time. But that's the general navigation on how you would solve for a loan lasting more than 1 year. So just as a kind of reminder, we are a non-direct recognition company, so we're in a short group of carriers that are non-direct recognition. So this is going to be important to your client as a benefit, especially with the debt elimination program, letting them know that they're still going to receive a dividend if they're taking a loan. So that dividend is going to be paid as if the loan was not taken. The loan interest will still be applied, but the dividend will also still be applied. This particular flyer is available in our marketing pieces tab. So if you want to kind of go there and take a look at this and maybe share it with your client verbally, that would be great. This is for financial professional use only, so it's not anything that you would probably leave with your client. Maybe some of the verbiage might be on a level that maybe you as the agent would only understand, but this is definitely something that you can use to consult to help your client through selling that loan process, and of course selling Lafayette Life as a carrier. Okay. So lastly, if you are working on in-force illustrations and maybe you haven't illustrated a loan prior to the case being submitted to new business, that's perfectly fine. In your book of business, you'll see the option to be able to complete an in-force illustration for your client, and you would use the same steps that we went over today in order to show them what a loan would do to their policy value. So I see we have a few questions, so I'm just going to kind of start taking these questions. And if anyone else has questions, please feel free to enter them in the chat box or the question box, and we'll be able to get those answered for you. And of course, if you have any other questions that maybe haven't come up, please feel free to give us a call on the sales desk and we'll be happy to help. Okay, so the question is, once the debt is paid off, we're encouraged to use the same monthly payment we were making to keep up the funding of the cash value in the policy. When should the policy loan be repaid? So that's a good question. And I think that has more to do with your client's kind of tolerance, I guess. So if you have, I'm going to find one of the illustrations we just completed. So if you have a client who's making premium payments for the duration, they may not want to pay off the loan until they're not making premium payments. Or some clients want to start paying off the loan right away. So I guess I would leave that to you as the agent in how you consult with your client on their debt elimination program. If there are funds available to pay off the loan, of course that's going to help the cash value be replenished so that when they're ready to take another loan, they have plenty there. Or if they are taking a longer time to pay off their debt and that's their preference, then they can continue to make premium payments and let the loan balance accrue and make a lump sum payment later to pay that off. Okay, so hopefully that answers that question. So another question is, what is the beginning age that a policy can be put on an individual? So all of our policies are issue age 0 to 85. Here's what I would like you to keep in mind, though. Generally, the policies are made up of the base premium, the term premium in order to avoid MAC, and the level paid up additions rider. So while a child, infant up to age 18, can qualify for the level paid up additions rider and of course the base insurance, they do not qualify for the term insurance until they're age 18. So that makes it difficult to avoid MAC. So when you have a situation like that, instead of doing your normal 35% to base and 65% of the premium to LPUA, you're going to kind of shrink that gap, I guess, and maybe do 50% to base and 50% to level paid up additions rider so that your base insurance is higher and eliminates the need for term to avoid MAC. So that's just my advice there. Okay, and the next question is, can the dividend be applied to pay back the loan? That's a very good question, and yes, it can. So what that would typically look like is just making that a dividend option from the beginning, or that's something that you can set up with policy services at a later date. Sometimes the client, even if you illustrate the client taking loans, they may not be ready to take loans when you illustrate it. That happens all the time. So if your client decides later to take a loan and then would like the dividends to go towards paying back the loan, then that's a form that can be completed with our customer service team, and they can use future dividends to pay off the loan. Okay. I do believe, oh, we have one more question. Oh, this is an underwriting question regarding immigration statuses. For underwriting questions and questions about clients with a visa or citizenship questions, I would go directly to underwriting. And the great thing is we offer an email box that all underwriters check, and they typically say that you'll receive an answer within 24 hours, but I've never seen it go past a few hours. And I use this email box myself. So if you have your pen or pencil handy or your iPad, the email address is ask, LLICUW, so that's ASK, LLICUW for underwriting at LLIC.com. And I would put as much information about the client as possible. And this can go for if you have clients with maybe some medical concerns that you think may keep them from qualifying for a certain amount of coverage, please use that email box, and the underwriters can speak directly to you. And, you know, if you give it straight to them, then you get it straight from the horse's mouth, and we don't have to kind of try to translate that information for you. So I think that is kind of takes care of all the questions that we have. Again, if anything else comes up, we're here for you. You can feel free to contact us at the sales desk, and we'll be happy to answer your questions. Otherwise, I hope that this was very, very helpful for you, and we would love to help process your business. So if there are any questions regarding pending cases or cases coming in, please call us at the sales desk, and we'll be happy to help you there as well. Thank you again for joining us, and we sincerely appreciate your business, and I hope you all have a great day.